There's a tax account that is strictly better than a Roth IRA for one specific type of expense, and most people who are eligible for it either don't open one or don't use it correctly. It's called the Health Savings Account, or HSA. This video explains what it is, why the triple tax advantage beats every other account, who qualifies, how to use it as an investment vehicle and not just a spending account, and what the one mistake is that destroys its value. What the HSA is. An HSA is a savings account specifically for healthcare expenses. It's only available to people enrolled in a high-deductible health plan, an HDHP. If your health insurance has a high deductible, at least $1,250 for individuals or $3,300 for families in 2026, you likely qualify to open an HSA. The triple tax advantage. Every other tax-advantaged account offers a double benefit, either pre-tax contributions and taxable withdrawals, traditional IRA, 401k, or post-tax contributions and tax-free withdrawals, Roth IRA. The HSA offers all three. 1. Contributions are tax-deductible or pre-tax if done through payroll. Your contribution reduces your taxable income, just like a traditional 401k. 2. The money grows tax-free inside the account. Dividends, interest, capital gains, all untaxed while in the account. 3. Withdrawals for qualified medical expenses are tax-free, not tax-deferred, free. That's triple tax-free. You put it in tax-free, it grows tax-free, and it comes out tax-free for medical expenses. The 2026 contribution limits: $4,300 for self-only coverage, $8,550 for family coverage. An additional $1,000 catch-up contribution if you're 55 or older. Why most people use it wrong. Most people open an HSA and then spend it on every medical bill throughout the year. Co-pays, prescriptions, vision appointments, dental. How the money goes in and comes out within months. This is the least valuable use of the account. The powerful use: invest the money and don't touch it. Here's why. An HSA invested in index funds for 20 years grows at the same rate as a brokerage account. But unlike a brokerage account, you never pay taxes on the growth. And unlike a Roth IRA, you can also deduct the contribution. Every American will have healthcare costs in retirement. The average retired couple spends $315,000 on healthcare from age 65 to death, according to Fidelity's 2024 estimate. That number is covered tax-free by an HSA. Instead of spending your HSA on a $40 prescription today, you save the $40 receipt and invest the $40. In 20 years at 7%, that $40 becomes $155. The $40 prescription cost is still reimbursable. HSA reimbursements have no time limit. You can file receipts from 10 years ago. So you pay the prescription out of pocket today, invest the $40 in your HSA, and reimburse yourself later. The receipt strategy. This is the advanced HSA move. Save every receipt for every qualified medical expense you ever pay out of pocket. There is no deadline to reimburse yourself from an HSA. The money can grow for decades, and you can withdraw the full accumulated amount, all tax-free, as reimbursement for documented past expenses. Mia is 34. She opens an HSA, maxes it to $4,300 per year, invests it in index funds, and pays all her medical expenses out of pocket. She saves every receipt in a Google Drive folder. Over 30 years, she accumulates $430,000 in receipts. She withdraws $430 from her HSA tax-free to reimburse herself. The remaining balance in the account, which has grown larger from decades of compounding, she can withdraw for any reason after age 65, paying only regular income tax, the same as a traditional IRA. Her HSA became a tax-deductible account with tax-free growth, with unlimited tax-free withdrawals for medical expenses, and a fallback traditional IRA after 65. What happens after 65? At age 65, the HSA removes its restriction on non-medical withdrawals. You can withdraw for any reason, no penalty, and pay ordinary income tax. This makes it functionally equivalent to a traditional IRA for non-medical expenses. Before 65, withdrawals for non-qualified expenses are subject to income tax plus a 20% penalty. That's why you should only withdraw for documented medical expenses or wait until 65. How to invest inside an HSA. Not all HSA accounts allow investing. Many of the employer-provided HSAs are just savings accounts earning minimal interest. Check your HSA provider. The best standalone HSA providers for investors: Fidelity HSA, Lively, and HSA Bank. Fidelity's HSA has no account fees and lets you invest in the same index funds as their brokerage accounts. It's the best option for most people. If your employer provides an HSA but it doesn't allow investing or charges high fees, use it to capture any employer contribution, then transfer the balance annually to Fidelity. The one thing to do this week: check your health insurance plan. If it's a high-deductible health plan, you're eligible for an HSA. If you don't have one, open one at Fidelity, link your bank, and set up a monthly contribution. If you already have an HSA, check whether the balance is invested. If it's sitting in a default savings account earning 2%, log in and move it to an index fund. Start saving receipts for all out-of-pocket medical expenses. Keep them organized. The account's value compounds as the receipts accumulate and the invested balance grows. If you want to understand how an HSA fits alongside your 401k and Roth IRA, the exact priority order for which account to fill first, that framework is the next video on this channel. And if you're trying to decide between a high-deductible health plan with an HSA versus a lower-deductible plan without one, the cost comparison for different health usage levels is linked here.